Hi, Barb Friedberg here. Here's the best long-term investing strategy. 6 easy steps to take to get you on your path to building long-term wealth. First, you have to set your financial goals. You're going to have long-term goals, retirement, intermediate-term goals, your kids' college fund, and short-term goals, going on a vacation, saving up for a new car, etc. Get those clear. Get a sense of how much money you need for each of those goals. Know your risk tolerance. Okay, when you're investing, you'll find that the value of your assets, your stocks, your bonds, etc., are going to go up and down. If you can't tolerate a lot of downward movement, because let's face it, every few years or so, the stock market will take a drop, sometimes small, couple percent, and sometimes large, 20 or 30%. If you're going to be at risk for selling after a drop, then you want to keep fewer stock assets in your portfolio, because selling after a drop is a bad strategy. So know your risk tolerance. High risk tolerance can afford to keep a greater percentage in stock market assets, 80, 90%. Those of you who are in lower risk tolerance areas, more conservative investors, you're going to want to keep 60-ish%. If you are a younger investor in your 20s to 50s, you're going to want to keep 60% or so in stock assets if you're a more conservative investor. Next step, which is so important, diversify your portfolio. If you keep everything in one sector, all tech companies, all large cap US companies, when that sector takes a tumble, your entire portfolio will fall. It's a good idea to diversify your investment portfolio with a wide range of US and international stocks, a smaller amount of bonds, and those of course could be bond funds, and a little bit of cash. Ride out the volatility. Don't look at your portfolio every day for money you're going to need in 5, 10, 15, 20, 30, 40 years. It doesn't matter what the stock market does today. Don't overreact to those falls in the market and feel like you have to do something. You don't. Just sit tight. Keep your portfolio low cost. Low cost portfolios have a tendency to grow more because more of your money is actually going into the investment markets and less into fees. Index funds are a good way to match the performance of the overall markets. And typically, those who invest in a passive index fund portfolio outperform active traders. And finally, keep your emotions out of your investing. Focus on your goals, not your headlines. I am Barbara Friedberg. You can find me on YouTube and at Barbara Friedberg Personal Finance, where we will have tons of investing information. See you next time.